Thanks, Nick. I'm delighted to be here and help kick off day 2 of what's going to be a great 2 days, I'm sure everyone will agree. So very excited, of course, to be able to help moderate and have a great discussion amongst the team here. We're going to be looking at ESG in 2022. We're going to be looking at it from a regulatory perspective. We're going to try and also look at that from a market perspective to see, how are things shaping. We want to understand how ESG and sustainable finance is evolving. What are the drivers, both market-driven, both as well as regulatory-driven? What are the implications? What are the implications for different actors in the system, buy side, sell side, the banks, data providers, and also investors? And then, of course, we think it's really important to also think about, well, what does it mean implications-wise looking forward? So very excited to welcome our panelists today. So I do want to make a warm welcome to Nadia Humphreys. She's from Bloomberg, where she looks after sustainable finance solutions. I also want to welcome Prashant Joshi. He's from BNP Paribas. He's the GM of APAC Regulatory Affairs. And I also want to warmly welcome Wilson-Otto, who's the Director of Sustainable Investing at Fidelity. So some great speakers, and I'm sure we're going to have some great perspectives from different actors within the ESG and sustainable finance area. One point before we go into the questions and start up the conversation, would love to hear from the audience. Nick mentioned there's quite a number, several hundred of you, so we'd love to hear questions, maybe not several hundred questions, but at least a few to keep us on our toes. So would warmly welcome people to add those questions, I think, to the comments field, and we'll try and answer as many of those as we can. Well, that's enough housekeeping from me. So let's get the conversation started. I do want to start with Nadia. I do want to start with this question of, how are things been evolving? Like, what are the drivers that are important? That question about regulatory drivers versus market-driven factors. But maybe Nadia, do you want to take us through or give us a little bit of a scene setting in terms of what the regulatory landscape, perhaps, of ESG and sustainable finance?
Yes, of course. And thank you very much for inviting me to participate. It's quite a cold and early morning here in London, but I've had the opportunity to watch the sunrise. So hopefully the caffeine has hit the blood and I'll be able to do service to your question. So what we're seeing from a reg perspective, really, I could summarize in 2 shapes. So the first shape is looking to mobilize capital to sustainable outcomes. And the second shape is more on the prudential side. So assessing things like climate risk and appropriately responding to the assessment on climate risk. So if I think about risk and prudential regulation and kind of how that's shaping up, what I would say here is there's an ask on organizations, both non-financial and financial, to climate risk assess their business, to identify what's called physical material climate risks to their business, and in some cases opportunities, and then at least have a plan either to remedy risks or to capitalize on opportunities. And broadly speaking, the framework that is most widely accepted across, I think, north of 80 different countries is TCFD, the Task Force for Climate Related Financial Disclosure. That has been adopted into legislation, for example, in the UK under the FCA. It is now mandated that large listed companies conduct TCFD. We're seeing it in Hong Kong as well for certain fund products and financial products that they need to climate risk assess. Now, on the other side, there are some tools being developed by legislators to direct capital to sustainable outcomes. And some of that is tinged with, please make sure that you are adequately explaining the sustainable nature of a product to your end client, and therefore preventing anything such as greenwashing claims, so false statements that you might be making about the ESG credentials of your product. The tools that we are seeing most commonly being used are things called taxonomies. The one that has come to market first is the EU, but looking to be followed shortly, particularly in the Asia Pacific region, by Malaysian taxonomy and the Singapore taxonomy. So definitely ones to watch. What they do is they try and define what is substantial contribution for a set of economic activities. And then maybe just to conclude my point, in terms of summary, it's kind of who are the actors. So actually legislation is impacting pretty much everyone. So issuers, i.e. non-financial and financial companies with regard to how green their operations are or investments. Similarly, we see it for benchmark providers. So there's encouragement now, particularly in Europe, to offer things such as climate transition benchmarks or Paris-aligned benchmarks, or a standardized set of ESG reporting for any ESG-based benchmark. We obviously see this hitting asset management. We see it in credit institutions such as banks. So there is a flurry of legislation in the ESG space.
Thanks, Nadia. So as you can see, a very rich tapestry and perhaps ecosystem in terms of the regulatory sphere. So different things happening, which Nadia mentioned, and then different actors in the system and who are, of course, being impacted. Prashant, I wanted to turn to you. You work for BNP Paribas. It's a bank. I'm really interested to hear your thoughts from your perspective.
Yeah, I think very much continuing the theme that Nadia has explained. I guess the actor-centric set of actions that are out there. You have the commitments, right out from the G20 and the COP26, which really advocated and kicked off motion for the TCFD commitment. Some of the net zero commitments really, they were defined at that stage. They were different, as you look at the globe, but that's expected given the different developmental stages that everybody's at. So I think the actor landscape right from the very highest level, over the last 18 months has really picked up, and we're seeing that really filter through, so as Nadia mentioned, that the patchwork of regulatory environment is really picking up. I think it's an interesting one. I'd almost classify it as complex, but not complex in some ways, because I guess markets do find their ways, and the area to call out here is the bond market, where we see the ICMA standards that are effectively voluntary, and they've set a base mark, and there are global flows, in the bond market active and happening. So in that sense, there are voluntary areas where some of these almost commonsensical norms and standards are picking up. So that's the not so complex aspect of it, and that's been there. You have the Asia Pacific Loans Market Association, etc. There are bodies that ISDA you have, for example, that can very readily roll out standards in documentation and legal frameworks. So that's the non-complex part. The complex part really comes in where we have some of these more macroeconomic commitments, at governmental levels, and that has a bearing on things like taxonomy. What thresholds of acceptability are, versus developmental stage that I mentioned. So as a result of that, we are seeing, a bit different views, based on taxonomy versus a principle-based view, for instance, has been spoken of in terms of that classification framework. But back to the focus of regulation hitting the banks and the various actors, not just the banks. It's actually more important on the non-financial aspect of it. Absolutely, as Nadia picked up the taxonomy developments there, the disclosure standards. I guess it's very entity-specific and actor-specific. We have the financial intermediaries having some set of disclosure requirements. You have the ESG fund standard where they're actually claiming a higher level of ESG alignment or commitments, and therefore their requirements are expected to be higher. In the EU, of course, we're an EU-based bank or domiciled bank. SFDR is huge at the moment. CSRD is becoming big as well, and you're seeing some of the disclosure standards pick up, of course, with the SEC in the US. So I guess that environment for disclosure is definitely picking up and aligning. There are the other areas like risk management, where we've seen, especially in Singapore and Hong Kong, some of that's coming to bear, and that brings us to really the data side, where the ABS, and I'm sure we'll cover it a bit later, has put out a questionnaire that really aims to pick up standardized fields, quite simple, simple and not, as I mentioned at the beginning, fields of information that hopefully aims to level out the playing field, as we often say. So yeah, they're my reflections on that one.
Thanks, Prashant. I do want to turn to Gabe. In particular, I want to ask Gabe about Asia versus global trends, but maybe just before we get to that, I'd be interested in your thoughts in terms of the market-driven forces versus regulation. Prashant mentioned the market finds its way. Obviously, you're looking at a slightly different angle. You're looking at from the investment perspective, investors, asset owners. Would love to hear your thoughts.
Yeah, sure. Thanks, Matt. From my perspective, I think that if we look at why we're in the position we're in now, with the explosion globally of regulation targeting sustainability and elements of it, whether it's a prudential risk side, whether it's a product side, whether it's a disclosure and standard side, there's just a huge proliferation of different standards and requirements. And for me, this is in direct response to essentially sustainability going mainstream, for lack of a better way of framing it, and trying to essentially create all of the tools, frameworks, and oversight structures to facilitate the emergence of sustainability as genuinely part of the financial system and as a way of directing capital flows towards the most appropriate outcomes. And so if we go back to when sustainability was niche, if we go back 10, 20 years, there was no real need for explicit standards on what a green product is, or there was the ability to, in Prashant's work, just let the market work. And if something was seen as being sustainable, it would be invested in by niche investors that are specialists in that field. As we move into more of a mainstream area, there is definitely the need for more appropriate labeling, taxonomies, oversight, regulation. And also as climate risks and other risks become more salient and also more impactful on companies' profitability, the frameworks for evaluating those risks are being integrated in more and more detail. And for me, if I think about some of the regional nuances in this, I would argue that in Asia, a lot of the development has actually been led from a regulatory mindset, where the regulators have been setting the pace and the industry or industry participants have been following to an extent. Interestingly, in a country like Australia, as you can probably tell from my accent, is my home country, it's a bit of a different approach, and a different approach within the US, where it's actually the investors and the market which are galloping significantly ahead of the regulatory catch up. So from that side, I think that in part it depends on where you are in the world with regards to the role that regulation versus market factors are driving on this. But I see the two as being intrinsically linked, in that the reason we've got so much regulation is that the market is moving towards that approach as well.
Thanks, Gabe. So we're starting to see divergence. We're seeing different approaches. We can answer this question in terms of different markets. Prashant, I want to turn to you, get your perspective. Asia versus global trends. Some of the underlying issues. So both trends from a regulatory point of view, but even things like data, how we look at E versus S. Grateful for your views.
Yeah, I think Gabriel raised a very interesting point around the sequencing and the nature of approach. So I think if we look back to the last the huge regulatory drive, which was effectively after the global financial crisis, and that's where really the US with Dodd-Frank led, and then you had the trade reporting, which is effectively disclosures. You had central clearing, and then you had margining, to further disincentivize bilateral activity that the regulators don't have transparency over. That whole sequence was very much a kind of US led, and then an EU followed, and then an APAC followed kind of approach. Here we're seeing something very, very interesting, and I guess that's also it's one of the outcomes of the nature of real economies as well. Where the US has quite a large fossil fuel base as well, anyway. So it's hardly a surprise. Asia, has been a production hub for the whole world for a lot of the last century. So I guess that's. And in terms of the regulatory drive in Asia, that's interesting. I think the regulatory bodies have certainly matured much more. Over the last 20 years, it's been a super fast growing area. Not only as far as financial services are concerned, but the capability of bodies that have authority. So the institutions, the industry bodies, etc., has really ramped up. So I feel that difference is there. And Asia is really very much with the discussion. Whether it's taxonomy or disclosure, bond standards, loan standards, etc. Something is there. Whichever country you're looking at, it may not have something as prescriptive as the EU taxonomy, but something is already there as far as each of the APAC jurisdictions is concerned in some form or another. So I guess that's the first point, touching on those differences. I guess the second one, there's a level of bifurcation that will have to be a medium-term priority. I think short-term, everyone's sort of coming to terms with this mainstreaming factor, which is very, very promising, encouraging from an awareness perspective. But then will come, the kind of seeing where everything lands up as far as bifurcation is concerned after everyone's made their initial efforts. You may not get, the level of alignment that, some expectations may be with right from the outset. So there will have to be a teething process that will unfold on a global basis. And I guess the other point here is on the ESG factors, where you have the environment factor is generally more consistently approached globally, irrespective of what region you're in. Science-based targets, etc. They make the subjective a bit less subjective. Of course, there's still disagreements. You could take the example of low intensity forest fires can actually increase the fertility of soil. And nature does have fires as well. That's been a historic thing. It's not just a new thing. So there of course is some inconsistency. There's some subjectivity, but much less so than the social and governance factors. Where you're looking at relationships with communities. That's effectively part of governance models. That countries choose to adopt a lot of the time, which business is a part of. So naturally there will be deviations, divergences, nuances, differences in the S factor and how that's really pursued by everybody in a country in that global ecosystem. And I guess lastly, you have a similar impact on the governance side where your internal relationship, although that's a bit more harmonized globally because there's a lot of globalization that's led to a lot more consistency on those factors, but the social one really does have a lot of divergence. So I guess there are differences in those perceptions globally, and we'll see how that pans out in the medium term. Thanks,
Prashant. So you've introduced the topic, of course, of data. So we've talked about regulation, we've talked about market drivers. Data is a very big part of this. We've heard about disclosure, we've heard about challenges in terms of different types of data, the whole question about climate versus, say, social factors. Climate, we're solving for one number in some ways. We're solving for a particular number. Social is a little bit more open-ended. Nadia, I want to talk to you a little bit about the implications. Bloomberg, data provider, very involved, very implicated in all these kinds of issues. What are your thoughts in terms of the data issue and what the implications are for data providers?
Yeah, thank you. I think it's a really important question here. If I think about it right now, I think the greatest challenge for market participants and, quite frankly, regulators is the lack of mandatory and globally consistent reporting standards in sustainability right now. And quite often you see people like me talk on panels about ESG data not being where it needs to be, and we say words like it's incomplete or inconsistent. Maybe if I took a step back and gave you some examples of what we actually see in reporting. Broadly speaking, I would say at the moment sustainability reports can act like PR tools for firms. Companies will selectively choose what they talk about and the metrics that they use to evidence what they're doing in a sustainable way. I think also there's some confusion. So even the actors that want to do it very well produce multiple different reports because they think they have to. Often there's been the message in TCFD that it should be integrated into existing reporting structures, but we see standalone GRI reports, standalone TCFD reports, because people are trying to kind of tick the box of everything. What we often see is a disconnect between the financial statements of the firm and the non-financial reporting, so the ESG reporting. Arguably, we see time lags. 6 to 9 months after the production of financial reports, we see the non-financial statements of the ESG data. And also, even for the same company year on year, we will see differences. So a company may selectively choose which subsidiaries it's going to report on. It may not represent 100% of its global operational profile. So it'll cherry pick certain pieces of its organization. And that's when we're talking about data challenges, what we really mean. So when we're asking for globally consistent reporting standards, and I think that has been listened to. So we see bodies like ISSB coming to say, we recognize this is a problem. We want to set international standards, of similar high value as IFRS and GAAP accounting in the financial space, we are recognizing that non-financial reporting is important, and we are recognizing that this needs to kind of move forward. I think the conflict there is, and Prashant kind of rightly drawed upon the fact that EU is leading the charge, and so the EU is working on the Corporate Sustainability Reporting Directive. They've got EFRAG leading that, and that is working in parallel to ISSB. So definitely there are things to watch in terms of many people rushing at the same problem, but hopefully we can get to a point where we will well coordinate and be able to fix some of the problems that we're seeing.
Thanks, Nadia. Gabe, maybe great to get your views. We've heard a little bit about selective data sharing, time lags, I suppose the piece about structured versus unstructured data. As an asset manager, you guys need to be looking at what corporates are providing. What are your thoughts and views?
I couldn't agree more with Nadia's comments. I'm sitting here nodding furiously. But basically, from my side, I think that there's a few different angles, problems, and challenges that we're facing. The lack of data may not preclude analysis on ESG credentials or performance of an issuer, but it significantly lifts the bar in order to do proper due diligence and understand the credentials of a company, which means that it makes it harder to make comparable decisions at scale or start to price these into investment decisions in more of a systematic way. And so for me, that data layer that Nadia was talking about is a critical foundation of any decision-making process. It's like trying to value a company and 10 companies have a different definition of profit or operating cash flow. It's pretty difficult to get to that conclusion and to the area of actually understanding what's happening if you're using different building blocks. So from my side, that's one area that I am super positive about in terms of the developments with ISSB and the direction of travel. It looks like there's global recognition that this is a huge problem that needs rapid attention. So in that sense, I think it's fantastic. The challenge we face as investors, though, is that we are facing increasing demands not only from regulators, but also from clients around the characteristics of our investments that we've made on their behalf. And so, again, the data challenges here really come to the fore in the ability to be able to provide that level of transparency that is increasingly expected and demanded, not only from regulators, but from our clients, also from civil society and other stakeholders, which are trying to evaluate whether the claims that asset managers have made are actually being followed out in practice. And so if we look at the raft of net zero commitments, is by asset managers, by countries, by corporates, everyone wants to know to what extent are they being followed up with concrete action. And without the data, it's very difficult to be able to demonstrate that. And so I think that there is a bit of almost a chicken and egg problem here, where people are looking for the data, they can't find it, and they're trying to figure out what needs to happen. There's a lack of regulation and standards as to how that data needs to be deployed. And then we have issuers and providers of information and data, which are then not sure how to report under, which standard to provide the information under, and also to which stakeholder they're providing it. And so I think that there's a lot of conflict with some issuers have told me that they receive 10 to 20 customized spreadsheets demanding they get filled out by different data providers or different asset managers or market participants. And it puts a huge burden onto corporates. So the idea of that standardized, consistent data set and consistent access for me is a huge step forward. The other side here that I want to touch on very, very quickly, because you mentioned it, Matt, was on unstructured data. And so the data that a company provides is not the only way of getting insight into their behavior and actions. We can look at government data that they have to disclose to the government, to other stakeholders. We can look at triangulation using publicly available information. We can look at sentiments, scraping, and other sorts of metadata sets in order to get a better picture of how a company is performing and operating. And so I think that there are a lot of different roles for data to play within the ecosystem, and they can provide different levels of insight for public or private companies or companies that operate in different countries. But again, that's a complete rabbit hole that I'll leave to the next panel to discuss.
Thanks, Gabe. I do want to stay with you though. So you've nicely laid out, and in fact, all of you have laid out kind of the dynamics, what's happening, the demands on different organizations, the demands on different actors. Staying with the buy side, You've also talked about some of the challenges around getting the level of transparency needed, etc. But what does it mean? I mean, I guess from a BAU perspective, obviously ESG investing has been around 20 years. You mentioned. What does it mean operationally? Like what does it mean to operate in this environment? How are you navigating this when the regulations are still kind of forming? You've still got to provide that level of transparency. What does it mean when we talk about the data issues from a technology perspective?
Sure thing. And for me, this again goes from the 100 years history of sustainable investing practices coming into something that's mainstream and needs to be embedded across everything that you do. And so instead of having to report for one fund, which may be a small amount of assets, and you can do something custom tailored and specific to what the characteristics of that fund based on qualitative analysis, you now have to do this at scale across your entire organization. And so if you're a large asset manager, you will hold thousands of different companies. And so how do you go about actually reporting the characteristics of the companies that you're owning as a firm? And then also how do you account for the financed behavior of your owner actions? So net zero is a great example. It's relatively easy to move to a net zero target and to report for an asset manager, that we don't have massive footprints by business model. Where the most of our emissions are is in the financed portfolio, where we've actually made the investments. So it's not our own four walls we need to assess. It's the operations of every single company that we've invested in or own their debt or have made a loan to. And so this creates a huge reliance on external data providers to be able to have consistent information. And so part of this goes to the different regulations that are appearing everywhere, where it's more product-based, where we have to be able to say, as a firm, these are the characteristics of our products, whether they're sustainable, whether they meet the EU taxonomy, whether they've got green investments, whether they've got social investments. All of that requires frameworks, standards, data sets, and then implementation across the firm. And so one thing that's often underlooked is actually that ESG integration across asset managers and banks is actually frequently a massive data transformation exercise. It's actually, there's a huge amount of project management work and system rebuilds that are required in order to provide the right information, tools, and reporting structures. And so from that side, there's been a shift at the product level and disclosure level. But if we look at some of the prudential regulation, there's also the shift towards how we as an entity are dealing with these risk factors in our investment processes. So it's not just the characteristics of our reports, of our holdings, taken in order to achieve those holdings and positions and the extent to which these risks are embedded. And the climate has been the key focus of it. We're starting to see this broaden with the social taxonomy in Europe. We've seen France introduce Article 29, which means that managers need to now take into account biodiversity risks, not just climate risks. So we are seeing an expansion of the areas of responsibility that need to be integrated. And so I would argue that we have product disclosure requirements, we have corporate level disclosure requirements, and then we have the prudential disclosure and management tools that we need to be able to embed and demonstrate. And so across all levels of the organization, regulation is having a huge impact on the day-to-day of how we do business, but also the sorts of products that are selling. I saw some great statistics highlighting that I think it was around 2/3 of products that were sold in this last quarter of the last calendar year were in SFDR green products. So it's highlighting that as the regulation moves, we're seeing the clients and retail investors shift alongside that in order to lift their own expectations. So on both sides, from a regulatory perspective and also from a market perspective, we're seeing a lot of pressure to act and perform.
Thanks, Gabe. Nadia, I'll turn to you just on this very similar question, trying to understand. So we've talked about disclosure, we've talked about data. There has been a push in terms of in certain jurisdictions to look at data providers. Would love to hear your views in terms of, one, how it's impacting your business, because you're trying to service the market on so many fronts here. But also, your views in terms of what the most effective regulation would look like.
Yeah, and thank you, Matt. And actually, just to pick up on some of the metrics, Gabe mentioned SFDR. So we've been looking specifically at the European UCITS market. And so under SFDR, if people are not yet familiar, it has a classification of a sustainable product. A lighter green product, if you will, is called an Article 8 product, and a darker green product is called an Article 9. What we've seen is massive inflows to the Article 8 and 9 products. In actual fact, in the last year, it's now tipping. You see more inflows to the sustainable products than to the unclassified, what are known as the Article 6. Now, whilst the AUM is still sort of 75% in the unclassified bucket, we are definitely seeing reclassification of products into these Article 8 and 9 buckets, and a lot more new issuance into Article 8 and 9. Now, within this, and I think Gabe touched upon it, the regulation asks for, and I'm borrowing a phrase from someone else here, but I really liked it, a little bit like a nutrition label. So it defines something called principal adverse impact indicators. So it's just a set of standardized ESG data. Now, it doesn't say those things need to conform to particular thresholds or levels. It's just saying, am I investing in companies that have, for example, a human rights policy? Am I investing in companies with a particular carbon footprint? Am I investing in companies that are operating in environmentally sensitive areas? Yes, no. Now, right now, the problem is for the suite of Article 8 and 9 products that are on offer, you don't have 100% coverage on that data. You know, one data point, for example, would be gender pay gap. That's actually only legislated to be reported in the UK. And so one of the problems there is quite a lot of companies, data companies, will just take the gender pay gap data reported from the UK legal entity of a larger operation and make that data set available. So in actual fact, when they're saying my coverage is great, so if I engage Gabe and he says, I want to come to Bloomberg and buy your data, he's immediately going to look for my coverage. He's going to say, right, Nadia, of this universe of companies, how much data can you offer me? And my caution to Gabe and to Prashant is coverage is not it, right? So if I'm there going, I am only giving you, for example, the UK legal entity of, I don't know, 1,000 companies, the gender pay gap information, that is not accurate data. You should only be using those companies that are representing, let's say, more than 80% of the global operational footprint of that company. Then that data is true. And I think this is the buyer beware. You can absolutely have really good coverage if you just take what a company says, scrape it off their report and sell it on. What you should be doing is understanding the context of the information that's being reported, and also understanding how to make that relatable. Now, one thing that data vendors will always do is unit conversions, making sure that they're kind of common unit conversions. But equally, you want to say, what is that number representing in terms of what a company is doing as a whole? Is that an activity metric? Is it an entity metric? In the taxonomy, one of the big problems is that they're looking at activities. And when you've got a heavily diversified business, if you're wanting to look at the carbon intensity of a particular piece of that business, arguably you can't take the whole legal entity's carbon footprint divided by the particular activity, because your number's not going to be accurate. Ultimately, you want the carbon intensity of the thing they're manufacturing or the many things they're manufacturing. Now, in some cases, data is not yet available to do that. And that, again, is a struggle, because you're saying, well, how do I appropriately represent it? There is language that is used often in European legislation, and it's something called the precautionary principle. And maybe just one place, Matt, if I could conclude on, is around carbon data. So at the moment, you will see a lot of carbon estimates coming out to fill the gaps where a company has not yet reported. And I think it is a data vendor's duty to ensure that the precautionary principle is applied, i.e. you can absolutely give kind of the mean median performance of those companies reporting. That may well be an underestimate of the companies not reporting. So you're basically saying the good companies that are telling you what they're doing, we're going to use as a baseline to estimate those companies that are silent. What the legislation asks, particularly for things like climate transition and Paris-aligned benchmarks, you apply a precautionary principle. So you say, if I have 100 companies of similar features, really, I should be closer to the 99th largest company in the data that I'm using, because as an estimate, what I want to do is encourage true reporting of carbon. Whereas if my estimate that the market is using is favorable, that company will stay silent because they don't want to publish a number that is much, much worse than the number the market is using by data vendors. So there are definitely nuances that people, I think, need to be very aware of when they're purchasing these data sets.
Thanks, Nadia. We do have a question that's come in, and it is directed to Gabe. And I'll give you a few moments to prepare, because we're going to switch over to Prashant to hear the bank's views. But just while Prashant is thinking about discussing that, the question, of course, Gabe, is Brian's asked about Fidelity reportedly, I don't know if it's true or not, moving into the crypto space. So just your thoughts in terms of some of these newer technologies and I suppose instruments and asset classes that have perhaps a reputation in terms of carbon intensity. So I would love to hear a little bit from you in a moment. But before we hear from you on that, Prashant, would love to get your perspective. We've just talked about some of the issues around carbon data. We've been talking about ratings. Would love to hear your view from a bank's perspective in terms of the implications as you're trying to operationalize these things, both from a financing perspective, but of course, we've heard also about risk management and prudential regulation. Would love to hear your thoughts.
Sure. No. I think definitely a lot has resonated on what's been shared so far. But I think using the conventional means of regulatory implementation, as you would say, that what determines your regulatory obligations is a few things, right? So it's where you're domiciled, your home regulator's approach. And then you have, that often can have an impact on your branches overseas if they have a parent that's in the UK or the EU or the US. And then you also have the local rules that determines that. So, I mean, the approach that we've taken from a regulatory implementation perspective has been very, very similar. What are the global obligations that we have by virtue of our domicile, and then what do we have locally? So I think a lot of cases, MiFID is the classic example where it didn't really work. Like if you're a US bank, you don't follow EU rules, and the same goes for the US, right? So I think as far as, Article 8 and 9 that Nadia touched on, the light green, the dark green, the labeling that's taking place at the moment. And I like that delineation between the existing, portfolio and reclassification of some of it based on how it maps to some of those criteria. And then you're looking at the new issuance that are really having a fresh pair of eyes based on a new set of criteria and a new market to some extent. So I guess that has applied before. It's having application now. I think some of the EU focus, where we're struggling with some of the data as well, to be frank, is really around that inconsistent ratings, where the comparison that I try to draw that I think has a lot of parallels is credit ratings, where it's not that because different credit agencies have different ratings or timings that they'll issue, a B, or AAA or whatever. There's a divergence. It's not that they all sing absolutely from the same hymn sheet. There may be timing differences on when they get that out. And it's really left to the discretion of the financial intermediary, on how to actually take a lot of this credit rating data and ultimately make an assessment on the credit risk that the bank labels, an investment or a product to be having. So I think to some extent, the onus it unfortunately does remain, on the bank side or on the financial intermediary side, where they have to consolidate, all these data sets again, for very new and evolving areas. And, we're having to look at a few different sources and get, a level of comfort that we feel isn't, you don't want to overdo it as well, because there's so many new providers now as well. So that definitely remains a challenge. I'd say the other area, to make a comparison in a slightly different field, was the identity point, where India, for instance, had the Aadhaar system of identity, and there's an idea that they wanted to link the KYC, process to make it standardized at a country level. And that's interesting. You don't see that in the credit rating space still. I'm not sure whether you'll see that in the ESG space, maybe sometime when the regulatory or the central authorities feel confident enough that there can be a standardization. It's probably not yet, but I think we're seeing patches of it, so we had the MAS, the Memorandum of Understanding with the Carbon Data Project was a really good step, because Singapore is quite self-contained. It's a smaller economy, so it's easier to do some of those, projects. So I guess some of that consolidation we are seeing, but I'm not sure how much. It's going to take a long time, of course, for all of this to come together. So I guess that's on that front. And then in Europe, we're also seeing investor preferences, that are being put forward, and MiFID and investor protection regulation, by way of PRIPS, etc., historically has always been there. So there's these nominations that can be made, and then we've seen the rise on the back of that, of the European ESG template, the EET, that can be filled out or catered for by the intermediaries. So there's a rush to kind of implement a lot of these templates and ensure that the right data is collected, from clients and then effected. So I guess the financial intermediaries, what is our role? It's kind of like what Gabe was saying before, where it's not necessarily our net zero was a long time ago, but it's really the investment portfolios and the second level of impact that we're looking at now, which is a bit more difficult to measure. It's a bit subjective. Many of the corporates, especially in Asia, are beginning on their disclosure journey. They may not have TCFD milestones as quick as some of the others, but as a European bank, the pressure would be on to adhere to a slightly more urgent outlook on this kind of classification. I think the other bit that I wanted to add, so that's more or less connected with what Nadia and Gabriel were saying. The other parts that are very sort of, I guess, more GM specific has been really, classifying some of the instruments. So I guess we've got this category of more or less a use of proceeds, so where you have a bond or an issuance of some sort of loan, even a repo. It's really looking at where are those onward investments going and how can they be assessed. So I think tying into Nadia's point around the carbon markets, they haven't had the best of history. If you look at Kyoto and how long the EU trading system has been around, it's really quite a long time, and the amount of confidence that people have had in that is really not so much. With the price not necessarily being aided, by such an infrastructure being in place, you have the whole very controversial topic of offsets. Where certainly in Singapore, you've had the regulator effectively cap 5%. You can only use it for 5% of your allowance, which is a great move. That's absolutely needed. Otherwise, you're going to get both pressing the accelerator and the brake at the same time, which doesn't achieve it too much. So the carbon markets and also the subjectivity that I want to say about some of this data, where there's still a lingering feeling of what is the opportunity cost? We could have polluted this much and now we don't. Are we going to be given credit for this kind of hypothetical scenario where we're not emitting, but we would have? We don't know, because the investor demand is actually changing. The nature of that demand, what is value, is actually changing. So those hypotheticals may go out the window very soon. I hope they do, because that would be the right direction. So I guess some of the carbon offset discussion, certainly for us at the bank level, is really quite prominent. It's ramping up. The trading desks are really building up, and looking at the China side as well, where the provincial kind of tests, to see how carbon trading could work, have been great. As a follow-on from what lessons have been learnt from the EU side. So I think that's more or less a roundup of what we're seeing in the banking side.
Thanks, Prashant. Very comprehensive roundup. Much appreciated. So let's turn to this issue of technology. Obviously, we've talked about issues. We've talked about potentially there's even applications of technology that can help us with some of these data and disclosure issues. But this question is slightly different, Gabe. This is about crypto technology. Reputed to have quite a large carbon intensity. Would be interested in your thoughts, and maybe the other members of the community.
Yeah, sure. For me, it's a super interesting area, because it really needs to boil down to what are we actually talking about and what are the problems or challenges associated with it. So if we think about cryptocurrencies, the key problem that people have from a sustainability or an environmental perspective is the carbon footprint associated with very, very process-intensive proof of work-based blockchains. So what that essentially means is that in order to process a transaction, you need a huge amount of processing power, which takes up a lot of energy, which then has an associated carbon footprint. So in part, it depends entirely on where is the energy coming from. And then it also depends in part on the model itself, in that it is incredibly process intensive by nature. So there's two elements which if we take Bitcoin as an example, the overall footprint of Bitcoin as technology improves, as processing power and processing improves, as grids become greener, is going to decline structurally over time. So what we would expect from that is an ongoing deterioration that in the extent of the carbon produced. So that doesn't necessarily mean it's not a problem, but it does highlight that it depends in part on the grid, it depends in part on the efficiency of how it's calculated. And this goes back to Nadia's earlier point on if you're trying to put out a footprint of Bitcoin or of any cryptocurrency, there are a huge number of ways that it's going to be calculated. And some of them are very consistent with the idea of it's like you own a factory and the emissions that it took to run that factory for a year, you take the number of units that you produced and then you divide it by that number. The other approach is to say, well, what was the actual incremental emissions that it took to generate that one unit? So is it a life cycle ownership view or is it an incremental view? And you get incredibly different numbers if you take those different approaches. So if you take an incremental view, how much does it take to process a little bit of a Bitcoin transaction or to mine an individual coin? The actual carbon associated with that, if you compare it per dollar invested, is actually not that different to some mainstream equity indexes. If you calculate it differently and say, well, what does it take to run the entire network for a year, and let's divide that by the number of coins in existence, then you get a much larger number. So again, there's a bit of a question mark, and a group called South Pole just wrote a white paper on the topic of Bitcoin footprinting, which is an interesting one if people have a spare hour over breakfast with a coffee. But what I think is really important here is that we need to understand what is causing that footprint. It's not that all cryptocurrencies are inherently massively carbon intensive. That's a false statement. So it depends on what is the underlying technology, and then what are the grids and the direction of travel, and what does that actually mean? The other really interesting thing here is that with the increase in Bitcoin in price, the per dollar invested carbon footprint has fallen massively as well. And so there are so many moving parts with regards to trying to get an accurate footprint. So from our perspective, we don't see cryptocurrency as necessarily being incompatible with sustainable investing. But the question becomes, we need to take a more nuanced view around what coin, what actual token or asset are we talking about. One of the fantastic things about blockchain solutions or some digital assets is that they can offer fantastic efficiency improvements and transparency improvements, whether it's solving issues on supply chain transparency, human rights reporting. There's some fantastic initiatives and products that are in the market based on this technology. So I don't think that we can have a black and white view, and that we need to understand the decomposition and to the points that were discussed, what's the appropriate calculation and how should we be comparing and tracking the trajectory of this over time.
Wow, looks like we've opened a bit of a Pandora's box in the last 3 minutes. Thanks so much, Gabe, for that. I am conscious of time. We've only got 3 minutes. I don't know whether the others kind of had a very quick view on that before we kind of move on to talking a little bit about the future. Nadia or Prashant, did you want to add to that?
I can't hold a candle to Gabe's knowledge on Bitcoin, I have to admit.
No, I think, Matt, just a few points on it. That the looking at the ESG factors, you have the E and the S, right? So if you're talking about democratizing finance and making it available, the whole DeFi discussion, CBDC, opening up finance a bit more, that you could argue has some S gains in one sense, right? So the environment side, it all has to be looked at in context, and it's a very tough call, isn't it? That's why the policy side, the public affairs side is very important. Being an active consultation, with civil society is important on this point, I think.
So thanks very much for that. So some very complex trade-offs. Who knows, maybe we'll be talking about clean crypto or abated crypto in the next panel. Look, we are running out of time. It is an opportunity, of course. We did want to look a little bit about the future. We've covered a great deal in terms of what's happening now, the evolution over the last 20 years of investing, ESG investing, although Gabe reminded us it was maybe 100 years. I don't know if he was at the start of that. We've talked a little bit about what it means today. We're probably halfway along the journey in terms of regulation, market dynamics, new technologies. We just covered crypto, of course. Would love to get a very quick snapshot from around the group, starting with Nadia. I mean, what do you think the key challenges are going forward? what do you think, what are the gaps in terms of where the market needs to be in, say, 5 years' time? What are those gaps that we need to fill to solve some of the issues that we're seeing today? Nadia?
I think maybe a concluding statement for me would be to the regulators in terms of sequencing. Quite often, I think we're seeing that the legislation first hits the intermediary, the financial market participant. And I think it makes a lot more sense, as I mentioned at the start, to look at the quality of the data reported. If the quality of the data reported is good, then you can start to build better regulation on financial market participants or the provisions of data. And so sequencing, I think, would be kind of my key concluding message, Matt.
Thanks, Nadia. Sequencing. Prashant?
Yeah, I think there's a number of speed bumps, if you like, along the journey, and you're looking at geopolitical landscape that's quite volatile at the moment, more than it has been for a long time. So I think this whole, with COVID, especially the disruption on supply chains, et cetera, I think it's wonderful that everyone's still come to the table on ESG, and they've not let, a lot of things sort of derail the discussion. There's absolutely nothing incompatible in one sense about pursuing, the ESG agenda in spite of the things continuing. But I think that's something which could cause, we mentioned the fragmentation issues at the beginning, and I think that's something that we have to keep an eye on. But other than that, I think I agree with Nadia on some of what she shared as well. I think the sequencing it's going to be very important, and I think the market-driven approach, it has to remain central. So long as that there are benevolent intentions on part of investors, that's when regulation needs to come in, and that's where policy needs to come in and say, look, you're returning back to your old habits. We can't have that. Let's go back to the back on trajectory again.
Thanks, Prashant. Gabe, last word.
Yeah, totally building on Prashant's last comment. So for me, if I think of the role the regulation can play, it's absolutely critical in providing harmonization, transparency, and the building blocks that are required to direct capital towards appropriate end users, but also to accurately reflect the characteristics of the individual products and risk management. So I think it's absolutely critical. What I would love to see is a focus on harmonization, in terms of not trying to come up with a different solution in every market. And so essentially focusing on what are the common elements, because I think there are so many common elements that are required as inputs into these bigger picture decisions, that if we get a global framework for those elements and building blocks, such as consistent reporting data and standards, that then makes it a lot easier to have the different country-specific or region-specific frameworks that are built on top of it. But because they've got the consistent inputs, everyone will understand and speak their own language. So for me, it's, if we think back to the company example or financial accounting example, it's the same as having a structure for accounting standards, but then not demanding how they have to be used for company valuation. Everyone can come up with their own version. The market come up with a solution around that top layer. But if they've got the common data and transparency, we can all be understanding how that decision is made and what the underlying characteristics really are. So for me, they're really the key points, is kind of building on that harmonization, not putting regulation in where it's not necessarily required to address a problem, and focusing on a more narrow area of where we can drive that common ground and common language.
Great, thanks, Gabe. So we've heard a little bit sequencing in terms of driving data quality. We've heard a little bit about kind of letting the market drive some of these changes, or at least being very focused in terms of where regulation needs to be targeted, with a view, of course, to harmonization. Harmonization, of course, being achieved in a very nuanced way, so not overly prescriptive. So a nice, tidy little wish list from the panelists. So thanks very much. I do want to thank our panelists, Nadia Humphreys from Bloomberg. Thank you. I also want to thank Prashant Joshi from BNP Paribas, and also Gabe Wilson-Otto from Fidelity International. Thanks very much to our speakers. Thanks for the RegTech conference for having the opportunity for us to speak about these things, and also to the audience.